strategies for shorter DTE days to expiration trades, a trade-off with iron condors. Let's take a look. So in most of our research, we show that selling premium at 45 days to expiration provides the optimal risk return. When we say optimal, we just mean in the decay graph, that's where our research has shown is kind of the optimal point. So one of the most common questions that we get is, why is 45 day to expiration? I mean, why 45 day to expiration trades? And what could happen if we reduce the number of days to expiration? We now have monthlies, we have weeklies, we have dailies. You know, why 45 days now? Why, guys, get with the program, Batista. Sure. Why not 7 days?
The game's evolving.
Why not 7 days, right? Mm-hmm. So in this study, we're going to try to answer the question by using iron condors. We could have used strangles and stuff, but we decided to use iron condors this time. We'll use strangles next time because I think this is a really good study. Let's go next slide. So we used the SPY. We used 13 years worth of data, and we sold the 25 delta puts and calls, every single one, 25 delta puts and calls, and then we bought the five delta wings. That's just like, those are like synthetic strangles. Okay. 25.5 is a wide iron condor. Sure. So it's like a synthetic strangle. So then we entered the days 7, 14, 21, and 45 days for an iron condor. Okay. Mm-hmm. We held to expiration. We looked at the win rate, the average daily P&L, the number of trades since 2010, because the number of trades matter with respect to, law of large numbers and everything else. Let's go next slide. So the purpose of acquiring the 5 delta wings for all the strategies was to standardize the likelihood of a max loss across different timeframes, right? Because that's, we didn't want to have some crazy loss in there, like in 2020 in the meltdown that would skew everything. So by buying the 5 delta wings, we had a max loss on every trade. Mm-hmm, mm-hmm. And remember, some of these trades are very wide. Sure. So as the delta of an option provides an estimate of the likelihood of the option expiring in the money, purchasing the 5 delta calls for each of these strangles results in each trade having the probability of approaching max loss at slightly less than 10%. You following?
Yeah, so far.
Okay. All right. I just want to be clear.
Yeah.
So, because remember, that's just because of the wings we bought. That's just the theoretical chances of max loss. So here's what we found. Over time, and this is really one of the better pieces that we've done in a long time. Over time, the success rate remains consistent. We talk about that all the time. Whether you do 7 days, 14 days, 21 days, 30 days, or 45 days, the success rate is always going to be in those kind of the mid 60s for that 25.5. Okay. That doesn't change. And even the daily profit. So over time, the success rate remains consistent. And even though the daily profit and the loss averages fluctuate, there isn't a statistically dominant time frame for maximizing profits. Nevertheless, it's essential to comprehend a significant concept when dealing with strategies that have a shorter time frame to expiration. We're going to get into that in 1 second, which is going to be obviously the losses. So you can see here, the win rate stays the same.
Mid 60s across the board.
Yeah.
Actually,
and the median daily P&L, okay, is higher on the short-term trades, as you would expect.
Sure.
You take more risk, you make more money on the 7 days, the 14 days, the 21 days, the 30 days, and then all the way down to the 45 days, which you're going to make the least amount of money on your daily P&L. Okay, that makes sense. Also, you're going to get a lot more trades when you trade the 7 day versus the 45 day. Right. So, when you're looking
so far, the math plays out. The probability of success is true. It's there.
But so far, if you just looked at this slide, you're like, well, then why wouldn't I do 7 days? Right.
7 days, 14 days looks
yeah,
like
I make more money. I make more trades.
Sure.
Why wouldn't I do that?
Yep.
There's got to be a hitch. There's got to be a gotcha. For every, what does Jim say? For every gimme, there's a gotcha.
Okay. I try not to remember, but yeah.
I try not to either. Let's go to the next slide. Can't believe I'm quoting Jim Schultz.
I won't do it. Go ahead.
So the table below illustrates the daily P&L instead of the median. So the last slide was go back one slide, please, John. This P&L here is the median P&L, all right?
Mm-hmm.
So that's like what happens the most times.
Yep. That's
Go to
the
the next
number
slide.
that was seen most times. That's correct.
Yeah. So go to the next slide. So this is the actual daily P&L, the average. All right. Now, this is a little different. So on average, trading the shorter DTs, such as the 7 days to expiration, may offer more opportunities, but over time, it tends to yield less favorable results combined with trading the 45-day time horizon.
Compared.
When you throw the losses in there, all of a sudden what happens is the 7-day doesn't look so good. The 21-day doesn't look so good. And what looks the best on here is the 45-day. That's why we call that optimal. All right.
Yep.
So all of a sudden, everything's like, okay, this is a little more tasty-ish. Now it starts to make more sense. This is the 25.5. This is the average daily P&L. Now we're going to go to the next slide. So due to the consistent use of the identical long 5 delta wings in each trade, the likelihood of reaching max loss is standardized at around 10% for all trades. We talked about that earlier. But this implies that when engaging in trades with a shorter time to expiration, there is a heightened level of volatility within the same period compared to the trades with longer DTE. The uniform probability of hitting max loss threshold for multiple trades suggests a greater number of trades may indeed reach the max loss point. So here is the downside to the 7-day Iron Condor that had such a good median number, but all of a sudden, the theoretical number of max loss trades, this is max loss, these are wide strangles, okay? This is why your number is negative, your average P&L is negative, is because 49 times you went to max loss.
Sure. And there's nothing you can do when you're at 7 days to...
There's nothing you can do.
Yeah.
You're trapped like a rat.
Yeah.
14 days was 28, 21 days was 9. Go back. John, go back. And then when you got to 45 days, it was only 8 times. So basically, a significant difference, only 8 times in 45 days and 49 times in 7 days, you get to max loss, over this 13-year period.
Mm-hmm.
Let's go to the next slide. Mm-hmm. So because trading lower time to expiration trades can be more turbulent, it's important to keep your position size even more conservative compared to what you'd use in the 45-day trade. If you're trading 0 and 1 DTs, trade small. Mm-hmm. This aligns with our cautious approach to earnings trades. Same exact thing. It's worth noting for simplicity, this study does not factor in various metrics, including implied volatility rank. So we're not doing this just when implied volatility rank is high. We're just doing it consistently over these periods of time.
Yeah.
And there's no risk management here. There's no mid-trade adjustments. So obviously there's the opportunity to improve on all those, on all those numbers. This was essentially the most conservative worst case. Let's go to the last slide. So the takeaways, when dealing with shorter days to expiration trades, it is important to establish distinct entry criteria, much like you would for earnings trades. It's essential to maintain smaller positions and clearly define your risk in order to manage the heightened trade volatility effectively. It's also important to note there are no apparent long-term advantages in terms of profit or loss or win rates associated with a specific days to expiration. However, in general, the lower days to expiration trades come with narrower management timeframes and demand more frequent monitoring and adjustments. What it suggests is it is easier to trade those 45 days. It is much more difficult and much more volatile to trade those 7 days. And in the end, unless you're really careful, you're going to have a negative P&L as opposed to a positive P&L with the longer duration trades.
Awesome, man. Good job. Good job by the team. We're going to take a quick 90-second break and come back. We got the opening bell next. Let's Tasty Live.